Welcome back. Squawk on a Friday morning. Take a look at oil. Front month is now October 72.96. It's down 40 cents, or about just over 0.5% lighter there. Overnight, though, we had oil on the rise for a second session straight after slightly stronger than expected U.S. weekly jobless claims eased demand concerns from the world's #1 economy. Let's get to John Barratt, Managing Director of Commodity Broking Services, joining us now live from down in Sydney. John, I was just thinking of the seconds before we came to you. In fact, while these words were just coming out of my mouth, and that is, look, in terms of correlations with oil, what is it correlated to these days? Because, I mean, I've seen days where correlations look so extremely tight, other days where it's like just all over the place. What's going on?
Yeah, look, it is a bit of a tough one because sometimes it falls in sync with the dollar. Sometimes it doesn't. Sometimes it falls in sync with inventories. I mean, a classic was just the other night when the DOE reported continuing rise in surplus, yet it went up. It's very hard at the moment to put it in sync with something. I think we just got to go with the flow with the market, and at the moment it's indicating perhaps there's a little bit of a low around that 70, 80 or 71 at the moment.
Michael.
Yeah, Michael Yoshikami here. I have questions. So let's go with the flow in the short term, but where are we looking if we take out and look at where demand is really at? I realize we have some concern about weakness in the economy, but what's the real price? What should the real price be? Forget the market for a second. What should the real price be at this point?
Look, I generally feel that it's when you look at where OPEC are and what OPEC need, when you look at where the market needs, obviously supply and demand would dictate it, but I actually feel the price should actually be around about 80 to 85. That to me is more the long run medium for crude oil where everyone benefits. So I think that to me is where we measure it as being the optimum price.
Jono, how vulnerable are the leading economic indicators in the commodity market to further losses if we do see quite an aggressive downgrade to the second quarter GDP number in the US, and also Bernanke talking bleak on the economy, perhaps?
Yeah, sure. Across the board, people will be concerned, but a lot of people actually factor in the fact that things are not that good. So I think if Bernanke comes out, it's got to be supportive. But generally speaking, with commodities, some commodities still remain relatively cheap. Other commodities a little bit more expensive. Copper, in my mind, still looking quite cheap. Some of the softs still cheap. Gold perhaps a little bit expensive. But I think the key will be what Bernanke can say in terms of stimulating and how he's actually going to stimulate the economies, because that will then ultimately flow onto the commodities.
Michael?
So, Michael Yoshikami here again. Back to oil.
Yep.
If it's at 70-ish and you think it should be 80, 85, that means you're long-term bullish on oil over the next year. I mean, that's basically a 15, 20% return, right?
You got it, 100%. Yep. Michael, one of the keys that the people don't really focus on, I think, we do become very Euro and US-centric in terms of the consumption of oil. But really what we look at, and once again, it's the China story. When I look at primary inputs to economies, particularly out of China, I see there's still that massive growth and massive consumption. And to me, that's one of the keys that will keep oil at certain levels, and if anything, perhaps push it back through that US 80 level.
China's insatiable appetite for the black stuff. Understood. John, I've got to go. John Barratt there. And we're back with Michael Yoshikami. Questions for him, email us. Squawk@cnbcasia.com is the address.